Thank you for joining our monthly recap. Today I'm joined by David Sokolovsky, Wealth Advisor with the team. We want to recap 2021 and look into 2022. So David, with that, let's look at the returns of the markets in 2021.
Yeah, so 2021 was a very strong year. We saw the S&P close multiple times at record highs, I think over 70 times this year. We saw the Dow approach records and the NASDAQ as well. And the performance for the year has been very strong. So the S&P ended the year up nearly 30%. One surprise was the underperformance of the NASDAQ. And I think we could talk a little bit about what drove some of that, but rising interest rates are likely to impact growth companies going forward, and that's something we'll get into a little bit more later. But if you look at the drivers of the strong performance of the S&P, it was really driven by a handful of sectors. So we have energy, which had its best year ever. We have real estate, which was the second best performing, as well as financials. So those three sectors. And then the last one was technology, but again, that's more of a growth oriented. But if you look at the top three of the four sectors, it was all value names. If we look at the bond market within the US, that was a little bit disappointing. So we saw the bond market was negative for the year, negative 1.5%. But there's more to that story as well, because if you think about the amount of inflation that we've had this year, and if we're talking about a 6% number, once you add 6% to that negative 1.5% return, you're talking about losing 7.5% of your purchasing power, which is very impactful to portfolios and people looking to use that money for retirement. So with that, I think the recap for the year, though, within the US was very positive, and the outlook for next year is strong as well. But JR, do you want to talk a little bit about international, which I think was different this year?
International was a major disappointment as well, similar to the bond market, where you had the emerging markets closed down close to 6% on the year, the developed markets being up about 6% for the year. So it was really kind of a flat year overall for international markets. In between what was happening in China most of this year, trying to figure out the crackdown and some of the challenges overseas, you can see why there probably wasn't too much performance, as well as it feels like the response to vaccines in the rest of the world compared to the US was a little bit slower. So as we look into next year, you could kind of argue that international is a very, very big value play overall. But as always, we're not going to anticipate too much as we look to rebalance. If you start to see some performance and pick up, that'd be the time to look at international. But overall, it was a pretty disappointing 2021.
So looking ahead to some of the trends in 22, JR, some of the things that we're keeping an eye on are inflation. Obviously, that's been the biggest topic of this year, and I think is not going to go away next year in terms of the headlines or really the impact. I think the housing market and real estate in general will be another area to focus on. And then lastly, I think, and these all three tie together, is the rising interest rates and some of the actions that the Federal Reserve is going to be doing. So we expect them to see the acceleration of the taper, and we expect to see that wind down sooner than initially anticipated. And then the potential rise in interest rates and what that might mean for growth companies and where there's opportunities. So Jared, with that, do you want to talk maybe a little bit about the inflation and kind of
look at it? 22? If you look at inflation, I mean, it will start to slow down next year just because of either monthly or year over year changes. But again, you look at January, February, March, it's probably going to accelerate even a little bit more. If you look, Social Security is going to jump about 6%. You're going to see record bonuses. You're going to see major pay increases. Over half the US states are going to increase to $15 minimum wage starting in January. And then you're going to see a lot of increase in rents. All of that together will start to kick in January, February, and March. So maybe by April is when you start to see the inflation numbers slow down a little bit. But again, we still don't see that going down to the 2 or 3% that the Fed would like all of next year. So again, that's part of the reason why the Fed could raise interest rates 3 times next year, to just kind of keep us on a steady economy over the next few quarters and years ahead.
Yeah, and I think one additional driver of inflation is just the budgets for state and local governments. So we saw that the projections for 22 are a 9.3% increase, so just over 9%. And you really haven't seen those kinds of numbers in the 2010s, right? It's really going back to the 2000s where you see anything even approaching that range. And so I think that also can fuel a little bit more inflation because, again, more demand. And that's really driven by a couple different items. One, it's going to be the increase in salaries that the governments are also going to be paying out. Governments are also faced with supply chain shortages and paying their contractors for the work, which they're likely to see pricing increases. So all these things have been budgeted in. But thinking of areas of opportunity and where there's some benefit, it's really real estate because as we see that the Federal Reserve has very clearly told everyone that they're going to be raising interest rates, that's going to create more demand. You want to lock in the housing price maybe today at a 3% mortgage rate, then tomorrow at a 3.25%, right? And as those interest rates go up, that impact is it's felt a lot more than a potential, 2% decline, let's say, in the price of a home.
And when you go back to the budgets increasing over 9% for next year, I've talked about this in the past where probably the biggest benefactor of inflation in the world is the US government. And the reason is, if you look at the over 20 trillion of debt, it's at a fixed rate. And a lot of it is very low. So as you look ahead, as things cost more and tax revenues pick up, it allows state and local governments to spend more money because tax collections, because of capital gains, we just talked about inflation, all the wage increases, property value increases, all that leads to more more revenue to the government. And again, most of the government, state and local government as well, are at a very low fixed rate. So as all that inflation picks up, the government is the biggest benefactor of inflation overall. So again, it might sound a little scary, but the reality is it's pretty sustainable because of that low interest rate that the government has overall.
And I think, Jared, that's been one of the benefits of, and we talk about inflation, some of the causes of that inflation leading or coming back to the COVID crisis in 2020. But if you look at the crisis in 2008, one of the things that we saw was that state and local governments actually cut their budgets. And that created a prolonged recession, a prolonged downturn. So we had a recession last year, came out of it very quickly. And part of that was driven by the actions of the Fed. So obviously you can't have it both ways. It's the Federal Reserve is also trying to figure it out. But I think the benefit of avoiding some of that prolonged downturn outweighs some of the challenges that we're seeing with inflation now, and hopefully the Federal Reserve can rein it in.
So let's look to 2022 now, David. Let's talk about maybe some of the surprises we might see, and then maybe recap of kind of baseline expectation.
Yeah, so I think as far as surprises, that the name kind of implies the design, right? We don't know what we don't know yet, but there are some things that we have a hint to. So for example, the Build Back Better proposal, that as of right now is not advancing, but there are talks and potentially that can come back in some different form. So there could be, on one hand, additional inflationary pressures, but on the other hand, some benefit, particularly as it relates to childcare and other areas, to create more productivity. I think one other thing, as we look ahead, is really the international recovery. So you mentioned this earlier, JR, is that international hasn't performed well this year, and I think if you look back a couple of years, it hasn't been the strongest performer, but this could be the year that we keep looking at it, and if there is opportunity, that's where we shift. And then, the only unknown really that I think is very concerning, or potentially very concerning, is the controlling of the inflation, right? So if the Federal Reserve can't get it under control this year or as quickly as they would like, that just means that they're going to have to take additional steps, which would likely mean a tighter monetary policy and would require us to reposition. But there are some benefits as well, because if rates go up, then all of the savers are going to benefit, right? If you have higher interest rates, bonds could be another opportunity to benefit from that.
Yeah, and the inflation is definitely the thing to watch for 2022. If the Fed is able to control and have the 3 rate increases level that off, we'll probably have a pretty decent return year in most asset classes next year. But it is definitely something to watch, because the last thing we want to see is something like we had in the early 80s, where we have to raise interest rates much faster than expected to slow down the inflation. But that'd be one thing we're watching for next year, to the surprise to the negative. The other potential surprise to the positive would be if the Omicron spreads very quickly, like we've seen, and sort of phases out pretty quickly. And maybe the surprise could be that this could be the last major strain, and that the global recovery, both in the U.S., we kind of quote get back to normal next year, and that could be a positive to the upside that, you know, seems a little bit hard to see as we're going through the midst of the Omicron at this point. So with that, we want to thank you for tuning in. I want to wish everyone a happy, healthy, safe new year. And again, as we look to next year, we're going to stay on top of the trends and shift as needed. With that, we'll see you all next month.
Thank you.